Hi everyone and welcome to another edition of the weekly Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, and we're going to walk through what's been moving the markets this week. Now this is a pretty big follow-up to a bit of a series that we've been doing heading into these two big news items coming out of Washington DC this week. We've had the first one being the FOMC, or the Federal Open Markets Committee. This is the group that sets interest rate as well as economic policy. And there was a big run up into this event, so there's a lot to unpack there. This is going to be a bit of a longer episode, but trust me, it's going to be worth it. Just to give you a bit more of an insight into how the market may be positioning now, particularly as we're heading into the back end of 2026 now. We also had not really too much clarity come out of Washington, DC around the Clarity Act. Now, this is the other big piece that we're waiting on, essentially legislation that sets the tone for how the whole industry will be governed, particularly in the US. And the idea here is that the rest of the world will look at how the US does it and potentially emulate it in some way. But what you need to know about this one is that it is at risk of rolling over, in the sense that if it's not put in front of a Senate committee by the 10th of August, there is a chance that the legislation may not see the Senate get a vote, get approved into law until 2027. This has been a big one that the market's paid quite a bit of attention to, because it creates some rules around more than just exchanges. It sets rules for tokens, DeFi, financial products in the crypto ecosystem, you name it, right? It finally adds that layer of security that innovators need just to be able to do what they do without people like the SEC or the CFTC coming after them. So regulators chasing them with a hammer. But this is also just a general nice continuation from our last week's story. So I recommend you go check that out on Swyftx Learn if you haven't already, where we're going to touch on a few of the items that we talked about here and loop that into what the results are. But I think the biggest thing we can start off with is the Fed meeting that we just saw. We have interest rates remaining the same. So really, on a headline basis, nothing's changed. But like anything, there's a little bit more to read into a lot of these events. Quite interestingly with this one, my takeaway was that really we just saw a complete repeat of what was said last time. And the key takeaways there for me were that the Fed Reserve, who are responsible for the policy that sets growth, inflation, as well as make sure that it's maintaining employment as well. They see growth being on trending to the upside, as well as employment, so the labor market looking healthy, but they still remain completely committed to their 2% inflation target. And this is the big one. He really hit home the fact in the meeting, just that came out yesterday, how the Fed will not step down from its 2% mandate. We went in the right direction most recently with the inflation rate stepping down in the US. But he did also mention in the speech that while we have seen inflation step down, trends are more important to policymakers rather than one-off prints. And that's something we spoke about as well a couple of weeks ago on the Squawk, that it's a step in the right direction, but it may take a lot longer for some of these metrics that policymakers look at to be able to start thinking about things like easing monetary conditions more than anything else. If anything, the market heading into this meeting was sizing on the perspective that there actually could have been hikes coming. Last week we did this piece where we looked at the probabilities that the market was pricing in. A week before the meeting, it was 11% chance that the market thought a hike could be coming. And then heading into it a few days beforehand, it was above 30%. That was pretty telling that the market was a bit jitterish, a bit scared that potentially there could have been a surprise rate hike. For reasons that we won't dive into today, but at the end of the day, we've seen the market come through with no change. Now, there were a few things with relation to the 2% target, the fact that rates didn't change. A few things in his speech that he acknowledged that I think interestingly paint the scene for how the market may proceed from here. One of the key things that he mentioned, while there wasn't a committee consensus to increase interest rates, he talked about that there are additional tools to fight higher inflation. And that's the key part of the puzzle here. For crypto markets in particular, risk markets in particular, obviously we're all looking forward to a period where the market's moving in a bull market fashion, basically trending to the upside for months at a time. It usually will happen historically in periods where monetary policy is supportive of growth and easing, right? So lower interest rates, more cash in the system, more cash freely available. But right now, the current consensus is that to get to that 2% target, we're either going to have to increase interest rates, which is what the market was maybe expecting, but we didn't quite see, or B, take those additional measures that we just spoke about, and which Walsh actually highlighted quite a few times in his speech yesterday, that could result in liquidity being taken out of the system. So one of these items is balance sheet control, selling off their bonds. The Fed does hold assets on its own ledger. That could be a way to understand that they've injected money into the system, Or what if they started pulling it out? Now, crypto is a very liquidity sensitive market. We have seen Bitcoin when there are fluctuations in the availability of cash. When we look at a few different risk metrics out there, that it doesn't quite like it when money gets all of a sudden pulled out of the system. We have seen it struggle to maintain its trends and generally can sell off as well. So it's not to say that it will happen, but we have seen that happen in the past. And one of the key reasons why they might go to, if they're not going to increase interest rates, why would they look at potentially this idea that they're going to pull money out of the system? Just overnight, we've seen the US 30-year yields start to break out. Now, the significance here is with the bond market, there's basically two ends. You've got the short end, so something like a 2-year interest rate, which is like a 2-year maturity for taking debt against the government itself, and a 30-year bond. Now, the short end of the bond curve, it's more influenced by these policymakers, right? So when they do make changes to headline interest rates, they talk about, look, it might be more easing coming or more hiking coming. That front rate interest rate does fluctuate quite quickly with how the market's thinking about short-term interest rates. But when you move into like your 10 and 30-year time horizons, it's really more of a market perception than anything else. It's not really something that the policymakers can control quite quickly, very easily. It is possible, but not as possible as the front end. And when we see something like the 30-year bond yields shooting up to levels that we haven't seen in quite a long time, May 2007 was the last time we saw these yields up at about 5.2%, like they are currently. It's kind of giving the market a little bit of a scare in the sense that the market is also expecting that unless something changes, the market's expecting more inflation. And the key takeaway there is if the market's expecting more inflation, they then rely on policymakers to come in and change what are the guardrails on the economy right now to try and reduce this perception of inflation running higher. So that's essentially what this chart's showing, that the market's also buying into this thesis that, hey, look, inflation may not be under control and that some intervention will need to take place, whatever that could look like, for the market to think otherwise. Now, this isn't a guarantee, it isn't a prescription, but what bond markets do very accurately is tell what the market is thinking, because the price of these yields basically are moved off of the market buying and selling these government bonds. So when you see these yields go up, people are selling bonds because they think inflation is going to continue to go higher. When the bonds are going down, the market's buying up these treasury bonds as well. So it's a bit of an interesting construct, really. And what it all means for crypto? Well, immediately we have already seen a bit of volatility in both directions. It's been quite choppy, just looking at a chart of the markets over the last week. But long term, if we take this whole perspective of like we spoke about, that the next bull market will come when monetary policy is a little bit more stable, if not easing, a little bit looser conditions for liquidity, and there's more money available for markets to receive. That would probably require, again, we talked about this 2% target, that being achieved. Now, while we don't know when that's going to happen, there's a few ways that I like to think about this right now. First of all, we do need to see some sort of shift, whether it's interest rates or balance sheet activity, to probably achieve that 2% target. Or if it's not something from a policy perspective, it's going to be something in the market. So we potentially see some sort of growth scare, similar to what we saw between the US and Iran. Not saying that's exactly where it's going to come from, but that's what it could look like, right? Other things that we could see is potentially a lot of the AI capex and rollout and valuations that we're seeing. The expectations for growth potentially in those equity markets, we could see that potentially take a bit of a wobble, particularly as we have seen Asian indexes fall double-digit percents most recently. And I'll be watching the US dollar yen, particularly on that front, because that's a nice little proxy for potentially the carry trade as well, which is, again, tied into equity risks as well. While we have talked about the potential negatives, there are some potential positives as to what this whole sort of scene could look like that maybe not many people are thinking of right now. If you have been following Kevin Warsh's appointment to his role currently and some of the ideas that he has about how he views the markets, there was a famous interview before he got the gig that he did believe that a lot of the data that the Fed uses to make these decisions on monetary policy are quite lagging. He was more of a fan that in the modern day, there are way better tools and more responsive metrics that may better describe how to track things like inflation, like growth. And he pointed to mean trimmed CPI as being one way to measure inflation. Now, currently they just use a yearly rolling CPI print. So they basically have a 12-month window and they're just rolling it, taking the average. What the mean trim basically does is it takes the outliers away. So if we do see like a huge oil spike, it essentially just removes that from the data set like we have seen most recently. So interestingly, if we think about the 2% target, We think about maybe in the future, we're not measuring inflation the same way. If we do look at something like the mean trim CPI, it's actually 2.6%. So it's closer to that 2% target than the current CPI reading, which is about 4.7% down here. Already you can see that there may be something shifting in the future, but again, like we don't know when that's gonna happen. We don't know if it's gonna happen. There is a bunch of task force that have been set out to reevaluate a lot of these key metrics, and it is speculated that we won't hear back from those committees until January. So likely things stay the same until potentially 2027 anyway. So there is that potential that something may have to happen in the short term in response to how the market is accepting what's happening right now. And the 30 years, one way of understanding how the market's thinking about things. And right now, the market is thinking inflation will go higher without any intervention or change. Now, that kind of puts crypto as in a bit of a deer in the headlights situation. We do have this Clarity Act #1, which may or may not pass. Obviously, if it does pass, that's great. It could result in quite an elated moment for the market, and we do see potentially quite a bit of confidence return in purchasing the assets. But again, if we do see the Clarity Act maybe get benched until 2027, that is the current consensus anyway. It just may suck the air out of the room for crypto assets potentially. And we add on top of that we could look at some sort of intervention coming in between now and the end of the year to bring down inflation towards this target. Maybe that's another thing to consider as well that could impact short-term and medium-term prices for crypto assets as well. If I had to wager a guess, I've been following Kevin Warsh quite a bit since his appointment to the position as Fed chair. He's of the opinion in the past that there are other ways to control inflation without changing interest rates. He goes as far as to say that it's even possible to reduce interest rates while still fighting against inflation. And one thing that he has pointed to is the idea of the balance sheet. The idea that the Federal Reserve holds assets on its ledger and looking to basically remove that because that is in itself a form of inflation. Money's been introduced into the system. His idea is to take it out. And this is a look at the total assets on that balance sheet. It's publicly available. It has been sold off since 2022. And this was by no surprise the peak of the inflation cycle as well when we did see it after that COVID era. It's been slowly selling off. So they've basically been rolling essentially bonds off of their balance sheet for the last few years until the start of this year. There were some some liquidity stresses in US dollar markets at the end of last year, which may have attributed to this little bit of a spike that we've seen right now of issuance. But essentially, this could be the first tap that he looks to turn off or even start to drain the sink rather than play with interest rates potentially too much. Because really the concern is that increasing interest rates from here might actually do more harm than good. So really, it's not a case of we know exactly what's going to happen, but right now we've got a few levers that we're watching to see what could impact growth, what could impact inflation expectations from the market. Just to summarize that, we've got this balance sheet that they could be impacted. There could be something outside of the markets, some sort of conflict arising, which can't ever foresee, right? But it's just to play it out what it could look like. Or there could be some sort of scare in terms of valuations and employment, right? And again, like a growth scare can also look like a reason why potentially we see employment levels change. And it's only most recently we've seen a couple of earnings reports come out of Meta and Google coming out far worse than what the market was expecting. That could then subsequently lead to more layoffs. I did see just most recently Visa also has started redundancies as well. I think they laid off 1,000 or so employees as well. So again, if that sort of flywheel starts turning, that could be something that forces maybe some pricing of the market's expectation for inflation as well. So really the key takeaway is understanding, again, the market is expecting inflation until something changes. And there's a few different levers from here that we'll be watching to understand where could that inflation change come from. And it's highly probable that it's not going to be anything to do with the oil market, right? It's likely going to be more to do with potentially changing this balance sheet, interest rates, or something else that's going to affect growth and productivity. Now that was a lot, so I appreciate it if anyone's got any questions. Please throw them in the comments and I'll do my best to get back to you as soon as possible. As much as nothing really changed with that Fed meeting, I think what happens now is the market starts to think, okay, they are doing what they said they were going to do, which is essentially let the market decide what happens next. And what happens next is we're seeing it play out right now. We're seeing the bond market break out like we talked about. And again, that's going to drive change as the Fed will now respond to how the market's going. That's the new world that we're moving into with this Fed chair. So that's it from me today, guys. Thanks again for sticking around and seeing this one through. Again, this is all very interesting. So if you're not sure on something or you want more information, please leave a comment below. I'd be happy to break things down further in a future video. Catch you later.